This is my personal trading strategy for gold, and I'll be revealing everything about it today. This will be the only ICT gold strategy you will ever need using liquidity sweep. What to expect from this video is that it will be a full course. I'm gonna go over the right way and the correct way to trade liquidity sweeps, also known as turtle soup, and we're gonna be avoiding the mistakes that other people do to stand out and be profitable. We're gonna be also going over the direction and bias, how to identify bias and direction, using different methods to trade the correct liquidity sweep, and then we're going to cover also time frame alignment, and that's going to be the correct time frame alignment from higher time frame to lower time frame, as well as intermediate time frame in between. We're going to be also going over the right way to trade liquidity and inducement, and the only two formation of inducement you'll ever need. Then we're going to be covering the lower time frame entries, how to enter on the lower time frame for confirmation and high reward to risk, and we're going to be finishing the video with examples and putting all together. This is going to be the final piece of the puzzle. It's the creation of a new great gold trader, which is going to be you. I really did my best in order to put this video for you in the easiest way, so make sure to watch the video until the end. It's your choice to either keep watching the video till the end or stop somewhere and go and look for another strategy. And I promise you that this cycle will never end, and it will keep looking for different strategies every day. Let's get into it. So starting with liquidity sweep the right way, and because our setup and the whole strategy actually is based on liquidity sweep, so we need to really understand the real liquidity sweep. We want to avoid the mistakes that other people do, especially beginners, and we want to learn the right way. Okay, as prices going up, one of the common mistakes that people keep doing over and over, and I see them everywhere, right, on YouTube, and you go to Twitter and you'll see someone actually catching this high, for example, going lower, and the reality of those trades is that you don't know how many times people kept losing until they found that one, and then they took a screenshot of it, posted it on Twitter, but in reality ignoring all of the other losses that they took. You don't want to be that person. What you want to be is someone who is taking trades that are higher in probability and avoiding the other ones that just keep losing. So what other people will do when it comes to liquidity sweep, price is actually trending to the upside. Now we know that there are some breaker structures here, but those breaker structures, there are some people who call them, masters of turtle soup or liquidity sweep masters, and all they do is look for liquidity sweep, but they are not smart enough to distinguish between a trade with a trend and a trade against the trend, as well as a continuation trade and a reversal trade. What they look for is always, taking any high, they're looking for reversal. They're looking for reversal here, reversal here, until at some point they get one and they post it in Twitter. We don't want to be that person, because our intention is not to post on Twitter, but actually be profitable ourselves. Okay, we don't care about how people think about us, either it's high or low reward to risk, but we are trying to focus on is make money. So instead of trying to catch the highs every time, we wait for price to reverse first, and then we look for the continuation. So the recent breaker structure that we have, for example here, that tells us that we are going to the upside. I'm not going to be taking a turtle soup of a high. Instead, I'll be looking for price to retrace, look for a turtle soup continuation with a trend. For example, we can see that price is going up, coming lower, going up here, and then we are bullish here, right? We are bullish because we have multiple breaker structures to the upside. What happened here? And the real turtle soup entry is going to be below this low, because that's your continuation entry, instead of trying to catch the high every time, which is going to be hard to catch, and you're gonna fall in that losing streak. So that's your continuation trade. When we are getting into a POI, either a fair value gap or a block, or another liquidity level, and then we are having that market structure shift in the lower time frame, right? So we got that market structure shift. We create a high. Sweeping that high now is your continuation turtle soup. That's what we are trying to focus on, because now we have a market structure shift. It means that we're bearish. We're looking for highs to be taken in order to continue lower. Same thing, breaker structure, high taken to go lower. We're not going to be focusing on the lows. So we need to first of all, identify our direction. And then if we are bullish, then we're going to be looking for lows to be taken. If we are bearish, we're going to be looking for highs to be taken in order to continue lower. And it's not the opposite as some people try to do. And again, they might be sharing some screenshots with you, but they're not profitable in reality. You need to understand that. So we're going up, we look for lows. We're going down, we look for highs to be swept. That's the real liquidity sweep. We always wait for a reaction of a specific level or the method that I'm going to explain later. And then we're going to go from there and we're going to, look for the continuation instead of the reversal. When it comes to the direction and bias, and we need that direction because that's what's going to lead us to trade the high probability liquidity sweeps, and is going to, guide us to trade only the valid ones and avoid the mistakes that a lot of people do, which is looking for the extreme high reversal or the low reversal instead of looking for the continuation with the current trend. There are different methods to identify the bias. The first one is this one, the higher time frame CISD, and that's the one that I'm going to be focusing more because it's the easiest and it works very nicely on gold. We're going to focus on this video, but still I'm going to go over some other examples covering the other methods that I also have and I made about 13 days ago. This is the ultimate ICT daily bias guide, 5 methods that you can use any. Some of them are advanced, some of them are for beginners. You can go and watch this video and then continue watching this video so you have an idea about some methods to use in order to identify the direction, because you really need that. But the one we're going to be focusing on today is the higher time frame CISD, the change in stated delivery, or in other words, the creation of an order block. Especially if this is already a higher time frame CISD, it's valid. But if we are also reaching another POI, for example, and we get this pattern, which is bearish candle and then bullish candle engulfing the previous one, that's a bullish CISD. The other one is last bullish candle closing below with an aggressive bearish candle. That's also a bearish CISD. When we see this, that's going to be an establishment of a new trend or a new bias or a new direction. This is what I'll focus on today. Okay, so this one, but feel free to use any of those methods. They're all going to work the same way. Some of them are, as I said, more advanced. Some of them are less advanced. So make sure to pick the one that fits you and fits your personality, and then you can continue watching this video. Time frame alignment. So those are the time frames that we're going to be using to look for the CISD and then look for the lower time frame entry. And if we're using an intermediate time frame, then those are the alignments. Now some people would call me crazy if I say that time frame alignment is in my top 3 of every trading concepts that ever existed, at least to me. As easy it is, that's the importance and the significance of it. That's why I really want you to understand time frame alignment and actually follow it exactly like this. So what we're going to be doing is pick one time frame, skip one and go to the other one. That's your higher time frame, that's your lower time frame. Same thing, higher time frame, lower time frame. Now if we're using an intermediate time frame, and we're going to go over that later in the video, you're going to know what time we're using 2 time frames and what time we're using 3 time frames. All of those details are going to be discussed later, but I want you to understand that those are the time frames you need, and this is the time frame alignment you need. So one time frame, we skip one and we go to the other one. If we're looking for a CISD, for example, on the 4-hour, our time frame entry is going to be the 15 minutes. If we're using 15 minutes as our CISD or POI, then 1 minute time frame is going to be our entry. So those are the time frames. You need to take a screenshot of this, or write it down and follow those time frames. If you're someone who more as swing trades, you could start from here, right? And if you like scalping, you could start from here, 15-minute and 1 minute time frame. There's gonna be high frequency trades entering on the 1 minute time frame. You're gonna have more trades. You could also use the 1 hour and 5 minute if you are you want something to be in the middle. Now if you're swing trading, you could use monthly and daily, or maybe weekly and 4-hour. Those, my best time frames actually for swing trading is weekly to 4-hour. This is really a hack to follow. If you follow those 2 time frames, you're gonna have those really high probability entries that are aligned with the weekly time frame, but entering on the 4-hour. This is the whole logic about time frame alignment. It's looking for an expansion of the higher time frame, but entering on a low time frame. That's all what time frame alignment is about. That's why using the time frame alignment that I'm having here is going to give you a higher reward to risk instead of just looking for an entry on the 15 minutes by itself. Now into liquidity, and those are the only two levels you'll need in this setup. Those are the only two levels we're going to be trading off. The first one is a structural inducement, maybe a new term to you, but it's basically an inducement that is part of the structure that in the lower time frame, there was maybe a mitigation or there was a pullback on the low time frame, definitely a pullback on the low time frame, but there were some people entering off that level on the lower time frame. And it's really a valid liquidity level. It's the first valid pullback in the valid swing. Now, what is valid pullback? We're going to cover this on the next slide. Valid swing, that's the swing that was created, when price was reaching that higher time frame POI, or when we had that, CISD, or the swing that reacted off that POI again and caused a market section shift or breakout structure. That's the valid swing. So basically, we can see that we got, for example, a sweep, market section shift. This swing here, or this range, is the valid swing. Okay, that's the higher time frame CISD or the lower time frame market section shift. I did explain this already. When we have those two candles, right, the CISD, we can see that at this level we had a CISD, right? But on the lower time frame, how does it look? Something like this. That's your CISD level on the higher time frame, and that's your market section shift level on the lower time frame. We can see as price was going up, creating that market section shift, and that's also higher time frame CISD level. What we can see is that it was starting to go up, pull back, going up, pull back, going up. Now the valid pullback, we're going to discuss this later. We're going to discuss the minimum candles or minimum, move in order to consider something or, a piece of price action, a pullback. So basically the first pullback in this valid swing is your structural inducement, and that's a level we're going to be using in order to enter. The other inducement levels, and that's my high probability level that I did explain before, but never explain it in gold and never put it in a whole trading plan. It is the mitigation inducement. The problem with a lot of people is thinking that when a fair value gap is tested, that's it. Price will never go back there. But just remember that as price goes to the fair value gap, it just gives me more confirmation that it's going to go back there, especially if the mitigation of the fair value gap is very small compared to the whole fair value gap. What does that mean? We got a fair value gap this big, the mitigation is this small. I know that price will go lower again to fill the other part of the fair value gap. So mitigation inducement is what? The first partial mitigation in the valid swing. Okay, so you see here, we got the same thing, CISD, high time frame, lower time frame market section shift. You can see we created a fair value gap here. What happened is fair value gap partially filled. We got a market section shift. As prices coming lower, I'm more convinced now that this is the highest probability liquidity level we have. Why? Because I did explain, I don't want to get into too much details. I wanted this to be as simple as possible, but know that mitigation inducement is one of the highest probability liquidity levels that you could trade off. So you see this fair value gap here is partially, and not to 50%, partially filled, and there is a big part here to be filled later, and now this is a high probability, perhaps in my opinion, the best liquidity to trade ever. Now, one of the most important concepts that we need to understand for this trading plan is pullback, especially the first pullback, the structural liquidity. We need to understand which one is the valid pullback. So what is valid pullback? Some people would say price going up, coming lower, going up. That's a pullback. Definitely it is when we have multiple candles going lower, but there needs to be some conditions applied there. And a pullback can be literally in one candle. So we could have just one candle that is a pullback by itself. What do I mean by that? So the first rule is that a candle, the last candle we have, when we have the low and the high of it, those are the levels we need to mark in order to look for a pullback. So you see, we got this candle, we mark the low of it and the high of it. If price just close above the high of it, but never touch the low, that's not a pullback. So here we have no pullback, you see, because the low here is protected. The low here is also protected. This one is also protected. Some people would look for this also for a market structure shift here or valid pullback, but in reality, it's not a valid pullback. Why? Because the low is protected here. Price never took that low and then push higher. You see here, it took the high, yeah, but never the low. On the other hand, this is the valid pullbacks here. We have different examples of valid pullbacks. The first one is protected low, but this one is not a protected low. So we have a potential pullback here. But when does it confirm? When do we have a confirmation that the pullback is there? We took the low. When we take the high, then that's a valid pullback. So you see, we took the low and then we take the high. Then the lowest point between the two is the valid pullback. Started going up. This low is not protected because we never came to it. But this low here, we took the low. We did not take the high yet. And then after that, we take the high. We have a valid pullback now. What is the valid pullback? You see from here to here, what is the lowest point? It's this one. Then that's a valid pullback. That's our valid pullback. So it is as easy as this. We have valid pullback here and valid pullback here. If this was our valid swing from here to here, or valid range, where do we have our first valid pullback? It's this one. That's the liquidity we look for to trade off after. The lower time frame entries, they're going to be actually two types we have here. We have the intermediate time frame and we have the lower time frame. So intermediate time frame, it means that we're going to be only focusing on two time frames. And intermediate time frame, when we have just a higher time frame, is going to be a lower time frame. But lower time frame is when we have three time frames. Okay, so it's going to be higher time frame and then intermediate and then lower. Three time frames. So this one is three time frames. This one is two time frames trading plan. The intermediate time frame is going to be only placing a limit order at the high or the low. When we have that pullback, when we have it's confirmed and we have a pullback with a direction or first mitigation, partial mitigation actually, then we can just place a limit order and that's it. Now this one, the pros of it, that it's going to be more relaxing. You don't need to wait for that, POI or that high or low to be taken and then you go to the chart to see the confirmation. No need. You're not going to be missing trades most of the time. The cons of it, on the other hand, is that it's going to give you lower reward to risk and there is no confirmation. So sometime when you have this intermediate time frame, you have a limit order, price will just go above it like this with no respect. There was no lower time frame confirmation. So if you're using this, you might not lose that one. Okay. But this one has also some pros and cons. So what is this one? It's looking for a lower time frame CISD after sweeping the high or the low. Now CISD could be replaced by a creation of a fair value gap, could be replaced by a 2022 mentorship model, whatever you're comfortable with. It's your confirmation entry. The one that I'm going to be using is a lower time frame CISD or a 3-candle pattern. Okay, something like this, 3-candle pattern. If you're not familiar with it, then just go and type 3-candle pattern Mulham trading and you're going to see my full video about the 3-candle pattern, how to find daily bias using it, how to find POI using it, and how to find entries using it. Pros is higher reward to risk and it's a confirmation entry. The cons of it is that you're going to be missing some trades. So sometimes price will go to that level, to the high, and then we'll just keep going lower. If you're using the limit order, you're going to get filled. If you're using the confirmation, you might not get a pullback, you might not get a retracement to get into the trade unless you're using a market order. It's going to be stressful because you're dealing with a lower time frame, and as you guys know, lower time frame is more stressful than higher time frame. You might lose multiple trades before winning. What does that mean? You got the high here, we sweep, we got a CISD, but then price will keep going up. You get a CISD going up, and then it's gonna go lower. So you might be losing 2 trades before the third one, which is the winner. But when using the intermediate time frame or the limit order, you're not gonna lose because price is still in that POI and it did not hit the stop loss. So you pick the one that fits you more. We're gonna go over examples of both. Now in this section of the video, we're gonna put it all together and I'm gonna go over some examples and how to actually approach this strategy and how to apply it on the chart. So again, this can work on gold and any other assets, but it really performed the best on gold. At the end, it's all about liquidity, and liquidity is the main core, what actually moved the market. It's all about liquidity. So just a quick summary over what we're looking for. Basically, what I want to see is, first of all, we identify the bias and the direction. That is by using any of the methods that I gave you also on my other video about daily bias. But simply, we could look for the CISD, the change in state delivery on the higher time frame. For example, here, we're going to look for a 4-hour. Or we could simply look for a POI and then all what we're looking for a respect of that POI with a market structure shift. When we get that market structure shift, what we have now is this valid swing from here to here. That's our valid swing. And that's where we look for the continuation, either by looking at the first pullback or the mitigation inducement. Just to make it easier today for you, we're going to be looking for CISD on the higher time frame, and then we're going to be identifying that valid swing on the lower time frame. So you see what is happening now is price actually going up on gold. Playing the price action, we can see, okay, we're going lower, no clear CISD yet. And yeah, so what we have here is what? We got a liquidity sweep. That's the first confluence. It's a liquidity sweep only with a wick, and then we are starting to go lower. What is that? We got this bullish candle here, liquidity sweep. The last candle before the liquidity sweep, especially a bullish candle, this is the one. We close below it here. That's a CISD. Now this price action leg, this leg from here to here, if we go to lower time frame, that's gonna be a market structure shift. Okay, so CISD on the higher time frame equals to a market structure shift on the lower time frame. What we see here is this: we actually took that liquidity, we push lower, we got a market structure shift either below this level, which is a valid pullback as we discussed, or below this major low, and we actually close below it. Now, when I see this, we always look for two things, right? In any valid swing, we look for structural liquidity, which is the first pullback, and we look for first mitigation or mitigation liquidity or mitigation inducement, whatever you call it. What we have here is that liquidity sweep, and then price started coming lower from here. We got a market structure shift. But then where's our structural liquidity? Where's the first pullback? It's actually this one. Price started going lower. We pull back here where we took the high of the candle and then the low of the candle. So the highest point is this one. That's our first pullback. That's our liquidity level. What do we have here? One mitigation liquidity here. Why? Because we got a fair value gap and it was not fully filled. But if we look from another aspect, looking at this was also into a fair value gap. So in this case, we actually have two things happening at the same time. We had that liquidity level, which is the first pullback, but it's also a first mitigation. So we have two in one, two liquidity levels, all at the same time in one high. We have the first mitigation and the first pullback. So that's our high probability. You could still see some reaction from here, but our highest probability is this one. What we can target, you could go for, a 3-to-1 fixed reward to risk, or sometime if you use a lower time frame, we're going to be discussing later, an intermediate time frame, or just going from higher time frame to lower time frame using two time frames. You could have a limit order here above this high because that's a high probability inducement level. Stop loss goes above the high, and then what we can target is 3-to-1, for example, gonna be around this level, or you could have targeted this low, or you could also go to 4-hour and look for a 4-hour structure, because the sweep here is part of a 4-hour structure. You could also look for a target of a 4-hour structure. So playing the price action here, what we see happening is price going lower and then going up. First of all, a small reaction of that first liquidity level, but not much. It was on Asian session, and anyway, it was not the best liquidity level to take. You see this one here? Price literally touched that level, started going lower. We played the price action more. We started going lower and we hit the TP. Now you could have, again, went for more, but let's look at what happened after. So in this 15-minute time frame, the same thing happening is price going into a POI. If we look at it this way, okay, going into a POI now, using the right time frame alignment, going lower with a market structure shift. If we look at this on a higher time frame, you're gonna see this as a CISD, but in this time frame we can see it as a market structure shift. Now you do this, you look for, first of all, we already got a market structure shift, which is at this level. We close below. Where is the first pullback on this price action leg? From here to here, and also so it was until here. Where's the first pullback that we have? It's always about the two liquidity levels that I taught you guys, the two liquidity levels. From here to here, we got this as our first pullback. We see we're going lower. Let me move this to the side. What do we have here? Is this high protected, this high protected, this high taken, and we took the low. But then again, so that's a valid pullback. But then we also took the high again and we closed below the low. So now this is our valid pullback. It's this high right here. Now marking this as our liquidity level, we could have actually entered from that liquidity level, and you could have a limit order here. In this case, you don't need to put the stop loss above, all the way above the high. You could have put it here or put it at the fair value gap. But let's say you follow your plan and you put it above this high. The same thing is you go for 3 to 1. That's it. Same thing. Now, let's say you miss this entry. What do we have now? What we have is this fair value gap, 1, 2, and 3 fair value gap. So actually, we got 3 consecutive fair value gaps happening here. What is this now? That's a mitigation of a fair value gap. That's first mitigation. Okay, the whole leg here is a first mitigation of a fair value gap. Therefore, we give this now as a high probability liquidity level for our re-entry. So we could look for this liquidity level now, this one here, and look for the sweep of that level. Do the same thing. So let's say you missed this one. This is your re-entry, because now this is again a mitigation of a fair value gap, and we could look for a re-entry from it. Okay, so your stop loss goes above this high, for example, and targeting another 3 to 1. You see, very easily achieved, and you could definitely look for more higher reward to risk. You see all of the trades that I explained now, they're all part of the 4-hour CISD. We should be always aligned with the higher time frame direction, because that's where we get the expansion on the lower time frame. You see, respected here. Again, we get this first pullback, but we did not come back to. Now we are starting to come lower. The moment you see a move like this, then you always wait for a new CISD, or you don't look for an entry on this leg. It might work sometime, but you want to look for a newer CISD, because you already got the move here from this 4-hour CISD. You wait for another 4-hour CISD. Now, let's say you want to look for an entry on the lower time frame instead. So you see this one here. When we take that liquidity level, you don't want to take the 15-minute limit order. What we do is, again, based on the time frame alignment, we went from 4-hour CISD to 15-minute sweep, which is this one, the continuation purge, or the first mitigation or first pullback liquidity. And then we go to 1-minute entry. You're going to have more precise entry. You could look for more, reward to risk. So let's go back here and see how we could have looked for an entry based on this. You're going to go to 1-minute time frame, and all you're going to do, I really prefer to look for entries on kill zone. So that's one thing that I forgot to mention. All what we're going to look for is a CISD. So we already got the CISD here because we got this last bullish candle. We close below. This is also a 3-candle pattern, right? Especially right here, 3-candle pattern, but the closure here actually confirms it. You could have entered from here or waited for a small pullback, whatever fits you. Stop loss goes above the high, so it's not going to be like this. You could have, but I really prefer to leave some room here, and then you're going to be targeting, in this case, 5 to 1, for example, or this nearest low, or you could have targeted the Asian low, okay? Because now we're also trading the Asian sweep, but in another way. I don't think you'll be catching 7 to 1 all the time, but let's do 5 to 1 and then take partials at 2.5 and go break even. So playing the price action, you can see we get a small pullback, and then you go up again, and then go lower. So we already half of the position. That's a break even, and that's 2.5 R taken, 50% of the position, and then we keep going lower. So we already took this liquidity level. This would be my first level. I mean, well, no, we did not take it yet. Okay, we took it, and then, yeah, we took that liquidity level, and we hit the 5 to 1. That's one entry. Now, the same thing happening again with the second mitigation here. Let's see. So we got the first pullback. If we want to enter on the first pullback, see, you see we got the sweep, last bearish candle, and then we got a bullish candle, and then a bearish candle. You could have entered here at the closure, or you could have waited for a fair value gap with the overlapping for price to come there. Stop loss goes above the high, and then again targeting. So let's do like this, targeting the nearest low, which is this one, but then targeting again 5 to 1 maybe. See what happened. Okay, this one you get stopped out. This time it was not the best. This is what I said about the lower time frame and higher time frame entry, or the intermediate time frame. Sometime you're gonna get stopped out. to enter again, and then you're gonna get the profits. So it's a little bit more stressful, but you get high reward to risk. So if you lose here, you already made 5 to 1 from another trade. Okay, so let's see what happened. Again, we got this liquidity level, but the re-entry would also be here. So you get stopped out, bullish candle, bearish, bearish. That's another re-entry. So plus goes above the high, and you see this one is running in profit, so already almost 2.5 hit. Okay, yeah, there you go. So we already break even now, but the same thing happening again with the 15 minutes. Okay, looking at this liquidity level here, see if we're going up again. We could have done the same thing, which is the CSD of that first mitigation or fresh pullback. You see bearish candle here. I mean, this is the last bullish candle. We did not close below it. It was a little bit tricky here. Okay, going lower. We got this bullish candle again. Mitigation of another of the main order block here, going lower. It was tricky here to enter, so I don't think I'll be involved in this price action. Even no fair value gap was created here, except this one. You could have actually, if you wanted, enter from this fair value gap, because we already had this closure below the main order block, creating a fair value gap. But actually this fair value gap is also a balanced price range. So you see fair value gap here. This is a delayed one. If you have no idea about balanced price range, it's the goat of PD arrays. It's the best PD array that you could use. So you see here, we got a balanced price range. We could have entered from this one, from the overlapping, for example, and then stop loss goes, for example, above the high, and then targeting again 5 to 1. Playing the price action, see that we're pushing lower, already break even and taking 50% partials. I'm gonna go 15 minutes just to make it faster, and then you see hit the take profit. So even if we lose here but then made it up with a 2.5 R, but we get it right here. That's how we go from 4-hour to 15-minute, and then if you want a 1-minute time frame. Now going back to 4-hour, the moves that we want to be involved with is, let's see, we had this one, the CISD. This is a price action leg that is higher in probability, and we can identify a liquidity level there. Another one, for example, is this one here. This one also is a higher probability one. This one. Also, if we look at this one here, because we had bearish candle and then bullish engulfing, so this price action leg here is a higher in probability. Maybe there was a liquidity level here, and that's where we get the sweep and we started going up. So that's a high probability one. Same thing happening over and over. For example, let's say not here. I don't like when it takes too much time to engulf a candle, but CISD should be happening rapidly and immediately. So for example, another one is this one here, but this is too big as price action. This one here, so that's a high probability one. We had a sweep on a higher time frame. We go lower and then we engulf. This one now, this price action leg from here to here, and we can actually extend it up to the highest point. That's a high probability price action leg and a swing. We could look for a first mitigation or first pullback liquidity. Price goes there and started going up. And even in this time frame by itself, we got our first mitigation here, and we got a sweep of that first mitigation. And then what happened after? This is now is the valid swing for the first mitigation. We get a sweep again, and we start going up. So even on the same time frame, because what happened here is price may be respecting another PD array on the higher time frame, and now this is your lower time frame or your intermediate time frame. What happened here is what? Getting that market or CISD and then the market section shift, which is an internal one here. And then where do we have our first pullback? So pullback, there's no valid one except this one. This is your first valid pullback. And what is it also? It's the first mitigation of the fair value gap. You see the fair value gap is not fully filled yet. From here to here, you see, we got a small part of the fair value gap as well as the order block. The price could actually go fill the whole fair value gap and then go to the order block and start pushing from there. You see here, we started going up. Now, what is the same thing happening over and over? You see, mitigation of this fair value gap started to go up. What is this now? It's a valid swing here. We always identify what? The first pullback and the first mitigation. We got this fair value gap here, right? This is the only one we have. We have one here, but we don't deal with fair value gaps that are this far. We always look for the extreme one. Now, we have fair value gap. Do we have a pullback here? If we zoom in, we can see that this low is protected, 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 protected. So there's no pullback at all here. And then we keep going higher. At this point, we started to come lower. Look at this first mitigation of the fair value gap. This is now our liquidity level. We sweep here and then we push higher. So on this time frame, if you just want to enter based on this time frame, you go long here, the stop loss goes somewhere in here, and then targeting 3 to 1. So you see you achieve that immediately, or you put your stop loss below the low. You could also do that and you're still getting that 3 to 1. So that's how we do it. Now the same thing happening where you can see that we're starting to come lower after taking this liquidity level, going up. We got a mitigation, but this one is filling the whole fair value gap, so it becomes lower in probability, but still you see we get some reaction of here going up. But here's the thing, we started to come lower from another PD array. So we got this order block here, and we got the balance price range, actually balance price range here, sniper entry here you could have gotten, and then we get a CISD and a market strategy shift. From this point, we started to come lower with a displacement. You look for the first pullback, would be, for me at least, you could have taken this one, but I would like to take this one because we got more down move after. You see the sweep here? We started pushing lower. That's what I like to see. And again, taking this liquidity, I just want to show you how those liquidity levels can work on any time frame. You see, sweeping liquidity, we push higher, we got the market such a shift. Now, do we have a valid pullback here? Nothing really. In this price action league, we get one that is really extreme. We don't expect price to go up and then come down to mitigate that one and then go up. It's not gonna be beneficial for the people buying. But what we have here is two consecutive fair value gaps, and first mitigation of the fair value gap, where was it? Here. Now this becomes liquidity level, and we take it here. That's our entry. Stop loss maybe goes here, and then that's an entry. Now we could do the same thing with 2 time frames if you are more as a higher frequency and scalping trader. What you could do is 15 minutes and 1 minute, and it's gonna be a limit entry or a limit order entry on the 1 minute time frame. It's gonna be finding a CISD on the 15 minutes, and yeah, really prefer to see the 15 minute CISD with the higher time frame and the 15-minute time frame order flow. So if we are bullish on the 4-hour, you want to look for CISD that is also bullish. So basically trading pullbacks on the 15 minutes. So an example of that would be, for example, let's look at any CISD that is, happen after price mitigating another PD array or price sweeping liquidity. For example, what I see is there's one here. What happened is price going up, pulling back, going up. We got this breaker block here now. Price was respecting that breaker block, and then we get the CISD. So again, what did we say about CISD on the higher time frame? It's equaling a lower time frame market section shift. If you could see this, let's say here we mark this valid swing here from here to here. On the 1 minute time frame, how does it look? We had that bearish move going up, bearish, and then closing above this one and above this swing high. So we had a closure above. Now you always ask yourself this question. Let's focus only on this. The question is, from this point, which is the lowest point before the expansion, where do we have our first pullback? Now, definitely, if you count this as your low, this is a valid pullback. But again, if it's really the lowest and it's not part of the expansion, I'm not really confident about it, okay? So always look for the swing that is really before the expansion, which is this one here, and the low before the expansion. After this move, where was the first pullback? You see, we're started to go up. The low here is protected, 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 not protected. So we have a potential valid pullback here. And now if we zoom in, we mark the low, it's taken, then we look for the high. Is it taken? Not here, but here. So between this point and this point, where's the lowest point? It's this one. So that's now is our valid pullback. It's this low here. And then we started to go up. And what do we see at this low? Now, this low is a valid pullback. It's the first pullback on this price action leg, but it's also a mitigation liquidity. We had a fair value gap, mitigate part of it. A lot of people here would think that, okay, it's time to push higher, and they're going to look for a structure here to enter. But in reality, price needs to pull back lower in order to fill the unfilled part. So what we can do here is simply mark this low. That's our liquidity level. We're going to be on the 1 minute time frame having a limit order. Stop loss could go below the low or below the main low here. And we can look for 5 to 1. Okay. And at 2.5, We're aiming for 5 to 1 because this is really, high reward to risk entry. We're aiming for that sniper entry to go higher from, and we're looking for 2.5 partials and break even. So if we play the price action, you can see that there are a lot of people who are trapped here who enter off this fair value gap because we have another fair value gap that is unfilled, and there are also people who entered off the order blocks here. If you're not aiming for the extreme order block, you might be in trouble when there is another fair value gap that is unfilled yet. So you see, we're going lower, taking that low. We got a CISD above. So if you were looking for confirmation entry, it would be entering here instead. But we're keeping it simple here. And then price push higher, giving you 5R with no drawdown. Drawdown was only 2 candles to the lower side. So that's 15 minutes. Now, again, if we want to look for another example, would be, let's see, to the current price action. Let me just identify one very quick. We can see that, okay, we're going up. We also had STISD here, but it was within 2 candles. I really prefer to see one within 1 candle. I really prefer to see one within 1 candle. Actually, we got one here. So you see, what happened here is sweeping liquidity. And again, we had this big move to the upside. Now, this example opens another aspect of thinking. You see, the same thing is we had this valid swing. The first pullback of this valid swing was this low, and it's also a mitigation or not mitigation. It was really close to that fair value gap. So this could be used as an entry here. You could have entered from here. But then the same thing also is that we got a CISD here. So this one is aligning with the higher time frame order flow. Okay, so we already respected another fair value gap here, and we got a CISD. Within the CISD, what we do is simply marking our valid swing, which is this one, going to 1 minute time frame and identify what do we have on the 1 minute time frame. What do you see is price coming lower, going up, coming lower, and then going up, breaking above. So already had that market such a shift. This was our first pullback. First valid pullback is this one. So price could also come here. So that's the first liquidity level we have. That's one. But also what we have is this mitigation, first mitigation. Is this valid? Now that's a question for you. Just have the answer of this question in your head. Is this liquidity level here valid? If you think that it's valid, then you're wrong, because of a very simple reason that this, it might be working sometime, but it's not the highest probability. The fair value gap here is fully filled. Price already went below and then pushed higher with a change of state delivery. In this case, we get that sense that it's not going to come back here because we already filled the whole fair value gap. We're not looking for this. Therefore, we can see that in the nearest future, we're not also going for this low. What happened after is, you see, we have a fair value gap here as well as a fair value gap here. So 2 consecutive fair value gaps here and here, and as well as this one. You can see that we have a first mitigation of those fair value gaps, which started going up. Did we fill the whole fair value gap? Not really. Therefore, this is now a mitigation inducement. We could enter from there, putting our stop loss maybe below this low or below this low, but we know that price is not going here. So could have put it here, targeting 5 to 1. That's it. Playing the price action here, a little bit of a drawdown, and then we are pushing higher to the take profit 5 to 1. There you go. Now same thing happening where also, if we look at this, so this is a winning trade. What we had here is also a push to the upside, maybe CSD on the higher time frame. Where do we have our first mitigation? First mitigation is this one. That's another entry that you could have taken. Now you could play with this trading plan the same as you want. I want you to understand how the market works instead of teaching you a pattern. I want you to understand really the basics and the core of the strategy so you can apply it on any time frame, any assets, and any market condition. So you see here again, same thing, 5 to 1 achieved, same thing. Okay, so that's how we go from 15-minute to 1 minute time frame. It's literally the same, looking for 15-minute TSD and then identifying the valid swing. We look on the low time frame to see if we have a valid pullback or valid liquidity inducement level, for example, and we go from there. So that's it for the video. I think that I covered enough examples to ensure the understanding and to ensure that, okay, I taught everything in details. The thing that I want you to understand from this video and from any other video that you'll ever watch on YouTube, the thing is, you're not going to be successful and you're not going to be a master of this strategy immediately. So it doesn't mean that if you watch the whole video, you're going to come to the chart and you'll see the same thing that I'm seeing, because I've practiced and I've been training myself. I've been training my eyes in order to see this identify it, understand the concepts to the core. You will need some time also to understand it the same as me or even better. Otherwise, it's not going to be fair to me. It's not going to be fair to others who put more time. And then you're thinking that you're going to have the same level of understanding within the same minutes after watching this video. It's not going to be like this. You will need some time to master this. So this is my only advice at the end of the video. If you think that I've helped you in any way, then make sure to share this video with your friends. You might be helping someone else. And also like and subscribe to the channel so we can reach more people and teach more people. That's it for the video. I wish you the best. Bye bye.